Hi everyone, this is Michael from Foxy Monkey, the personal finance website with information on how to build wealth, how to create a passive income, and limited company investing. As I like to say, your money can work harder than you can. I also run the Company Investing Academy. If you own a limited company with surplus cash and you'd like to learn more about tax and investing, then please check it out at companyinvestingacademy.co.uk. Now, I'm really excited today because I had the pleasure to talk to Andrew Craig, the author of the bestseller How to Own the World. Andy, who I respect both as a person and as a professional in the investing community, has done some amazing work to educate the general public on complex financial topics and explain them in plain English. There was so much content in this episode that I had to split in two parts. In the first part, we're going to talk about global equities as a vehicle to own human progress and innovation, whether people should invest at all-time highs, why people should avoid actually owning property as a first investment at least, and the real inflation behind the government statistics. The second part is more about crypto, very hot topic, I know, biotech companies, a peek into the future, and plain English finance, the community that Andy has founded, and their multi-asset fund. So yeah, I hope you enjoy this episode as much as I did. Let's get to it. Andy Craig, hello and welcome.
Hi, Michael. Very good to be here.
Nice to meet you. And Andy Craig is the author of two best-selling books. Okay, so the How to Own the World and Live on Less, Invest the Rest. I initially heard of the first one, How to Own the World, like 4 years ago or so. And when I read it, it gave me a totally different perspective or how to think about investing, okay, and how to assess different asset classes, how to think in ratios between different asset classes, and why the middle class can now do what the rich used to do. Back then to build wealth, and we were talking about this with Andy, a few minutes before I hit the record button. And when I reached out to my audience and said, I will be interviewing Andrew Craig, the author of How to Own the World, I received so many responses and so many questions like, can you ask Andy, this and that? So I'm really excited about this, and yeah, so I'm really glad to have you with me.
Thanks. Thank you. And obviously, I then said to you that I hope your audience haven't watched me in any other forum, because I so often say the same thing, and I hope I don't come across too much of a broken record doing this with you. But great to be here.
Yeah, I'm sure it will be an interesting one. We plan to cover lots of different asset classes and your plans with plain English finance and some interesting things that you do as well. But why don't you tell us a little bit about you, like a short bio, like how you got to where you are now?
Yeah, well, this is particularly where I hope nobody's watched any of my past interviews, because it's the same answer every time. But I mean, but
short one.
Yeah, I'll do my best. It often turns into a 15-minute answer. I mean, basically, I did economics and politics joint honours at a British university back in the mid-90s. I then started work as what my grandmother would have called a rogue trader, or an evil investment banker working for Swiss Bank in the late 90s, and really did 20 plus years until very recently, when I just quit the day job in the city to go full-time plain English finance, as you said. I've started in bonds at Swiss Bank, moved into equities, and have just spent, I guess, a little bit more than 20 years in London mainly, but with a stint in New York, working for Swiss Bank, a Swedish investment bank, a French investment bank, and a couple of British firms. Most recently, I was a partner for the last 6.5 years at a little investment bank that specialized in biotech. And I guess what I've always done is smaller company or mid-cap company equities, which is quite a niche little area where you're talking to institutional investors with large pots of money. And I guess you and your audience are more familiar with what that means and who they are than some other audiences I talk to. But the job is really to call up somebody who's in charge or has stewardship over a large asset pool and sort of say, look, we think this is a really interesting company, you should consider buying this today, or, oh, do you really own that? You should probably sell that. And so, which is great fun, and it's a real privilege to kind of meet the senior management of those sorts of businesses. And I worked out not that long ago, I've met over 1,000 management teams in my career, and it is the chief executive and the chief financial officer. So it's a wonderfully privileged position to be in, but it's definitely a young man's game. It starts very early in the morning, and it's quite a complicated and fast moving thing to try and talk with vague authority on hundreds of different companies at any one point in time. And some people are very good at it. I don't think I was ever particularly good at it, but I certainly found it very interesting. And that was part of why I moved to biotech a few years ago, because it was the chance to go from being a generalist to talk about hundreds of different companies across many countries and sectors, to being a specialist in the life sciences biotech space, which is an area I'm very passionate about, and I think we'll come on to in more detail. So hopefully that was vaguely short.
Yeah, that was great. No, that was great. But now you're taking a different stance by, again, trying to talk more about, generics, right? Different assets, how they can all, be used in one's portfolio to build wealth, and how people can benefit from that, right? How the middle class can benefit from that. So let's start, for example, with equities, and no surprise here, because global equities have done really, really well in the past 10 years or so, and thanks to this bull market, I have many people who reach out and ask, why would someone invest in anything else but equities if they only go up, basically? So that's one question that I have for you, and the other one is which kind of an antithesis of that is, why would someone invest in equities if after such a great run they will all come crashing down, right? So it's two different perspectives perhaps, and I'd like you to hear your thoughts about them.
Sure. Well, look, I mean, there are two things I'll say. Firstly, I see investing in equities, certainly in the way that we approach it, as investing in human progress. And I talk about human progress as being the single most important investment theme in human history, right? I mean, basically, Moore's Law, Gordon Moore, Intel, IBM in the 60s, came up with this idea that the cost, basically the processing power per pound, dollar, euro, yen, whatever, spent per currency unit doubles every 18 months. And that is the underpinning driver of every single technological development of the last, he came up with the idea in the late 50s or the early 60s, and there's been work done since then by Steve Jurvetson, who's on the board of Tesla and is a West Coast VC, has shown a chart that goes all the way back to the steam age. And says, amazing enough, that incredible exponential development of human technology has gone literally back to like 1750 or whatever, and it hasn't stopped. And I think it will continue. And really, that's why we have airplanes and massive tanker ships and skyscrapers and semiconductors and everything. And so, it's that global growth, both in terms of human progress, technological development, and then a corollary to that, the related thing is population growth, because the more technologically advanced we are, the more population we can sustain, because our agricultural productivity is better, and healthcare is better, etc., etc. So it's that explosion in humanity, both in terms of population and wealth, of the last 2 centuries, that is what drives equity performance. And actually, what that means long run is that the US stock market, for example, if you go all the way back to 1872, has annualized 9% per annum. That's from late 19 going back to 1872. It's probably higher than that now because of what you just said, because the S&P is obviously up even more since then. So you're talking about high single digits, roughly 9-10% annualized returns. But then to go to your second question, but when we're at all-time highs, and somebody starting now might be pretty scary. I've just said, all other things being equal, you should invest in equities. But what do you do when they're really expensive? And you'll know there's lots of academic work that says that the return profile of 3, 5, 10, 15, 20 years after an all-time high of a market is obviously a lot lower than it is if you get in March 2009 when the S&P was at 666 or whatever it bottomed at spookily.
That was it, yeah.
It was 666. Yeah, it's slightly the number of the beast from the Bible, which always freaks me out slightly. But the answer is, you should look through that, but it's that so the equities, all of these people are a great thing to be in because of human progress, something I said. And it's your mechanism by which you monetize human progress, basically. That's what the stock market is, in my view, at a very fundamental level. But set against that is volatility, to go to what we just said a minute ago about the 3, 5, 10-year returns from here. And volatility meaning, 1999, 2000, stock market's halved. 07, 08, 09, stock market's halved. Or worse, I mean, the US stock market halved. The Thai or the Indian or the emerging market stock markets, Brazil or wherever, did far worse than that.
Don't ask me about Greece.
Yeah. Well, I follow Greece quite closely at the time, actually.
Oh, do you? Yeah.
Broking Greek stocks, enjoying that.
I cannot really talk about, Greek stock market or any stock market for that matter when I'm in Greece. Anyway, I don't want to interrupt you. Please carry on.
No, that's fine. Well, you've had some good, what was it? Folly was a great equity story for a long time.
Folly, Cri. There are a few.
Yeah. Or the Coca-Cola, Hellenic Coca-Cola, the bottling company. That was pretty good from memory. But anyway, yeah, we digress. But to me, there's actually a really easy way or elegant, simple way of legislating for volatility, right? Because, you want to have exposure to equities, you want to have exposure to human progress to succeed financially. And again, everything we do is about multi-decade time frames, because ultimately that's it, the more you think about wealth and wealth creation over long time periods, the more successful you are. There's a lot of evidence for that. So it's all about patience and all that good stuff. But how do you legislate for volatility? Well, the answer is, and I cover this in my second book. It's kind of the reason I wrote the second book, Live on Less, Invest the Rest, is because I'd sort of failed to include this idea and treat it fully in the first book, which is what a lot of financial advisors going back to like the 1940s have described as 100 minus your age. And the point there is, so imagine you're 30 and you've managed to save £10,000, let's say, to use a British example. Somebody in Britain, they've had a half decent job in their 20s. They've probably spent a bit too much money having fun and, on furniture or going out for beers or restaurant meals or chasing, the object of their affection and going out on dates and stuff. And so, but they still managed to get to 30 with £10,000 saved, right? And then they have that in the stock market, to your point, which is, with the S&P at 4,200 or wherever it is right now. I haven't looked for a few days, but and there's that 50% correction, right? So you've gone from £10,000 to £5,000, or even a bit less than £5,000 if it was the 07, 09. It was 56% March 07 to March 09. So that's really annoying. And it's frustrating, and you've gone 10 grand becomes 5 grand or 4,400 or whatever. That sucks. And you're like, oh, why did I save and invest in the stock market? But now consider somebody who's 60 and has got £1 million because they've had a pretty highly paid job. They've listened to people like us for 20 years plus of their lives. They've sorted out their ISAs and their pension and maybe bought some commodities, whatever. They've just done a good job with their money over a lifetime. And so now they're 60, they're approaching retirement, they're really excited, and they've got £1 million. And they have the same asset allocation as the 30-year-old I just mentioned. So they have the same percentage diminution in their pot. Well, going from 10 grand to 5 grand it sucks, as we just said, right? But going from $1 million to 500,000 with the same percentage problem is obviously a much, much bigger, more catastrophic concern.
Something else, yeah.
Yeah. So the 30-year-old's got 30 years between there and 60 to make back the 5 grand they lost, and they've only lost 5 grand, right? But the 60-year-old is on the eve of retirement and wants to look after their family and, to be able to relax and all that good stuff. So, and they've lost in absolute terms, whilst they've lost the same percentage, the absolute cash amount they've lost is $500,000. That is catastrophic, right? And so the answer to that, which is why I come back to 100 minus your age, is that one of the most important things, one of the most important elements of our message is that if you own all asset classes in all major regions of the world, which is basically, the US, Europe, and Asia, give or take, with a few bits and pieces of nuance in there. That's got like a 2-century track record of you can be quite aspirational with capturing that human progress, making good money, but also the negative correlation inherent in negatively correlated assets like commodities versus, they're not always perfectly negatively correlated, by the way, but if you have some gold, it probably hedges the S&P fell 56%, as we just said, 07, 08, 09. Gold went up 19.5% in 09. Oil hit an all-time high in the middle of 08 when the world was crashing around. So that's the main sort of thrust of what we say, all assets and all geographies. But the other factor to consider is to look at your age and where you are to the 30 versus 60-year-old trajectory or point I just made a minute ago, and to think about the asset allocation to more. The older you get, the more defensive you need to be. And so to answer your question about what should I do about equities, to me, the answer is quite simple. If you're 30, you should probably still be putting 70% of whatever you can afford to invest every month. That's the 100 minus your age. So 100 minus your age, you're 30, 70% should go into aggressive assets, right? Because of that point about if you have a terrible crash, you've got 30 years plus to make it back, right? If you're 60, you should probably only have 40% in equities and 60% in defensive. And then a lot of the work we've done in the last year particularly is the problem with this idea. The original idea was equities and bonds. So if you're 50, you should have 50% equities, 50% bonds. If you're 70, you should have 70% bonds, 30% equities. And if you're 30, you should have the other way around, right? And it's not my idea, right? It's a very well-known idea. And it's why people like Vanguard have their life target funds or, target date funds. And that's broadly how they work. The problem is that when interest rates were, let's say, 6% or even 8% or even 12% back in the, early 80s, the bond bit, the cash or bond bit, your defensive bit, was actually making a decent return as you build your wealth through your life up to retirement. And then for people retiring, it was, so if interest rates are 6% and you've got £1 million, you get £60,000 a year of income off that risk-free, right? I mean, I did a paper round when I was 12, 13 years old, and I used to get 10 or 11% in my post office savings account, right?
Amazing.
Risk-free.
Risk-free, yeah. You actually covered kind of, you're going into that direction, covering my other question that, does this advice hold true for, for how aggressive or defensive you want to be in a very ultra low interest rate world, especially if interest rates become negative at some point, right?
100%. So my answer is yes, but you need to think much more creatively about the defensive bit. And there are, I actually wrote I wrote a 5-email series that people can find in the opinion section of my website.
What's the website?
Plainenglishfinance.com or plainenglishfinance.co.uk. They both work. And so if you click on at the top, there's an opinion. Click on opinion, and actually it's a bit clunky. You have to scroll back a couple of years.
No, I'll share it. I'll share it in the
I'll share the link. I'll share the link with you. But it was basically a 5-email series about 100 minus your age, and so articulating what I've just said, what it is, and the 30 versus 60-year-old point I've just made, and then it was sort of like, okay, fine, so. Rather than thinking in terms of equities and bonds, let's think in terms of aggressive assets and defensive assets. And the aggressive bit's really fun and actually quite easy. You can have just the S&P 500, or if you want, you could have the MSCI World. You could have a big equity index that owns hundreds of quality companies. You can get a bit more funky and have smaller companies funds, because smaller companies not many people know this, but UK smaller companies between 1955 and 2020 averaged 15.4% annualized returns with a lot of volatility.
That's the asterisk, right?
But if you go back to my point about if you're 30 years old, by all means have some smaller company stuff, right? Have some biotech stuff. And I've just talked about our biotech's averaged about 14% per annum for the last 20 years, roughly.
Amazing.
And people are sitting in cash ISAs. I mean, it's ridiculous. Because of course you have to be concerned about the volatility, but once you legislate for it in the kind of what I think is quite an elegant way I'm talking about, which is using 100 minus your age, you can get the right percentage allocated to stuff like that, and then you can benefit from the returns without worrying overly about the volatility. If you know what you're doing, if you automate, if you invest every month to pound cost average, and if you stick to your guns. And we always say, like, okay, if you are 30 and so you've been doing 70% into equities, small cap equities, biotech equities, whatever, and you've been shooting the lights out like so many people have in recent years, if you have a calamitous big crash and you keep doing it for another 5-10 years, you will be fine, because the basic rule of thumb is even the most volatile equity markets tend to get back to above the high water mark within intra 5 years. So even if you're down 70%, you've got some, micro cap mining fund or something, 5 years later, you'll probably be back up. And if you keep doing it and you keep that asset allocation, you'll probably end up with certainly high single digit, quite possibly low double digit returns. But you just mustn't be doing it if you're 60, because you haven't got the time to wear that, if you need to retire. So then, but to your point, so the aggressive bit is easy, and crypto to me sits very squarely in the aggressive bit, and it's the most aggressive of the aggressive bit, right?
We'll get to crypto, but
crypto.
Definitely a very hot topic. But I'd like also to ask you, where does property fit in this portfolio? Because we only talked about paper assets, right?
So my basic position on property is that for most people, they already have a massive personal exposure to property by virtue of owning their home. I should declare an interest here. I am a renter, and I'm 46 years old with a wife and 2 kids, and I'm a renter.
How do you go to cocktail parties?
Yeah, I know. It's not a very palatable position in the UK, but look, it served me incredibly well for all sorts of personal. And property is intensely personal. I'm a renter because I've moved abroad a few times, and but basically because I'm now a full-time entrepreneur, and the capital that I've been growing at a rate that, by the way, is a lot higher than the 2.5% rental yield that I'd be getting if I was renting out a property I owned right now. It is what has enabled me to have my own company and to go full-time entrepreneur. Now, I can afford to pay myself out of my savings now for a while if plain English finance doesn't make any money, right? Which if I'd bought a house, I probably couldn't. I mean, it depends. But anyway, that's probably a bigger discussion, and as I say, it's intensely personal. But for most people who get on the property ladder, which I sometimes refer to as the property snake, by the way, because it can be a property snake. But anyway, again, moving swiftly on.
Yes.
But for most people, especially in this day and age, with property valued where it is and costing what it costs, that's property covered off. And I think you really, that's a very big exposure in your personal balance sheet, and therefore you should focus just on equities, commodities, bonds, maybe crypto, whatever else, paper assets as you describe them, because you're covered off in property, and to have yet more exposure through a real estate investment trust. But as I say in one or other of the books, or maybe both of them, as you get much wealthier, property is a key pillar of it. I mean, I think I talk about 10 different asset classes in the book, which is, all of the above plus derivatives and insurance and whatever else. But and then I think that what you could do is, I would probably want to get any additional property exposure through the equity market by buying either property companies or real estate investment trusts.
Rates,
because the bits, if you're a British person, you've got a UK property, whether it's in London or Edinburgh or Aberdeen or wherever it might be, Bristol, whatever, wherever you are in the country, you've got that exposure to British residential retail property. So if you then have enough wealth to justify an additional exposure to property, my intuitive feel would be you probably want to have an exposure to commercial property, overseas property, and maybe overseas commercial property before you get more exposure to UK residential. So if I owned a house in the UK, I probably wouldn't buy UK house builders, as I'd probably prefer to buy, I don't know, some Asian property or European or German, and I would probably, before making that decision, be looking at things like rental yields in Frankfurt or Berlin, or I'd be trying to do some sort of that's actually
assessment.
The Stockholm property market is really interesting right now because because yields are just completely different to what they are in the UK, which implies prices are probably more attractive. But of course, in doing that sort of comparative analysis, you better be sure that that's not how it's been for the last 200 years, and it's just a structural feat. It truly is anomalous. But so anyway, sorry, that's a slightly long-winded answer. But I think broadly, I think most British people have. Well, I know that most British people factually have cash and cash and property and nothing else.
Yes, I think this is why it's very controversial to say those words to British people who are all about property, bricks and mortar, can't go wrong with that. And especially the past 20, let's say 30 actually years now, that property has had a fantastic run, especially if you invested in London or the Southeast, and benefited from also the interest rates drop back from the 80s to today, the net migration, the demand for property that the UK enjoyed, all these things. And I really like your the way that you think about the exposure bit, because if you have already a very large mortgage, then you have exposure to property. So why buy a second buy to let? But what a lot of people I meet tell me is that they really like the stability or the rental income that comes with it, right?
It's tangible as well. It's like,
it's tangible.
It's not like a piece of paper that tells me I own 500 American companies like the S&P, right?
Which you cannot show really. So that's another reason I think a lot of people own. It's also, we are social animals. We seek acceptance, and we also want to have social capital as well, not only working capital, right? And I was actually reading a brilliant article about NFTs, since we talked a little bit about crypto, that NFTs are a way to show that you are, either very early, or if you own, to show basically that you own crypto and you own expensive crypto, and basically show like
you're
signal.
Part of the gang,
signal in the digital world.
But I think that whenever that's your motivation for making investment, you're probably more likely to fail than succeed, right? I mean, investment should be an area where you're not doing it to. I mean, it's analogous to buying a brand new Ferrari. Look at me, I've got a brand new Ferrari. It's probably a very stupid decision financially, unless you are extremely wealthy. And an awful lot of people who own really flash cars shouldn't, right? Or have very, very ostentatious weddings. I mean, I was saying this to my wife the other day. The percentage of people's annual income that so many people in this country spend on a wedding celebration is one of the things that prevents them from actually ending their lives with a decent pension, as crazy as that sounds. Because it's like, if there are two people on an average British salary and they're deciding to have a £50,000 wedding, which we know happens, that's basically going to put them in debt for the whole of their 20s or early 30s or whatever. They're going to lose out on all those years of compounding. And I don't want to sound like some sort of curmudgeon, but my great grandparents, who by the way were from, on my father's side, are from Northern Ireland, right? Northern Irish puritanical Presbyterians. They would be absolutely horrified by what we do in that respect nowadays. So anyway, sorry, I've gone on a bit of a rant, but I think when you're making the broad point is when you're making financial decisions to be in the club and generate social capital and feel better about yourself, rather than just boldly to try and make a good investment return and build wealth through your life, I think there lies danger. Whether it's property or NFTs on artwork or whatever else.
Yeah. Although there is still a lot of I don't want, if I want to call it investment in things like antiques. People, especially rich people, invest a lot in things like wine, art. And there are now platforms that make it easier for the middle class to invest in these things.
And look, those have been benefiting from really similar themes to London property or prestige property, right? When you say, because actually I think it's really important. So you referenced all the reasons why properties, more households, big demand, but supply shortage, where else? The supply of money, which is the corollary to the interest rate, but. I have this argument with my dad quite a lot, whose idea is that, you'd all be able to afford, your generation would all be fine with buying 6-bedroom family homes in, Mayfair, if only you didn't eat too many smashed avocados and, eat out to it. It's like, no, and the reason that I was actually just reading this morning, Winchester is the most expensive city in Britain right now in terms of multiple of earnings of people who live in Winchester. And that multiple is 14 times. So the average house in Winchester is 14 times the average person's salary in Winchester, right? Wow. Now, I believe a big part of that dynamic in the UK, because, I say to my dad is, in 1984, when he bought a property in Wimbledon in southwest London, right, there were 4 billion people in the world, not 7.5 billion people in the world, literally, right, 4 billion. There are 3.5 billion fewer people in the world, right?
When was that? In the 90s, you said?
1984.
84, yeah.
So the population of the world has nearly doubled. Now, not only has it done that, but in 1984, Russia was communist. China was properly communist, not sort of essentially capitalistic.
Yeah.
And so the only Russian and Chinese buyers of prime London property in 1984 were a few hundred people who worked in the embassies. Okay. There are now hundreds of billionaires in China and thousands of centimillionaires in China, many of whom, and obviously we all know about Russian oligarchs, right? Many of whom, London is still lots of British people are very negative about our country. Oh, we're rubbish and we're useless, everything, and we don't have a technology or an industrial sector, which is all, by the way, nonsense. We're still really actually rather good at a lot of things, in my considered opinion. And what was the point I was going to make? Yeah, and sorry, and for that reason, because of our fashion and our contribution to Hollywood and Downton Abbey and all sorts of, and the royal family, all this sort of brand Britain, right? A lot of very rich people in the world, not just in Russia and China, by the way, but all over the world, aspire to owning property in London or the south of England or even Scotland or whatever, and sending their kids to British universities or maybe even British schools. The global elite wants to do that. And the sheer volume of the numbers of people that want to do that and work really hard to make that a reality by getting money offshore into the Caymans or Hong Kong and to afford it and get their tourist visa or their investor visa or whatever is of an order of magnitude that is just unprecedented compared to every other age. Now, I would contend that a big part of the reason that British property has done what it's done, apart from all the other factors like low interest rates, and it's just ultimately, the lower the interest rate, the higher the capital value of an asset, right? I mean, which, by the way, could unwind, which is something we could come on to. But I think what I missed in the first edition of the book, and I covered in the third edition of the book of How to Own the World, was a cascade effect from that. Because if you think, those buyers only have an influence on central London, on Mayfair and Knightsbridge and Notting Hill and whatever. No, they don't, because there's an elderly couple in South Kensington that bought their house for 700 grand in 1993, and they've just sold it to a Russian oligarch for 18 million pounds in 2019. Wow. And their three kids then get 5 million each of inheritance, and then they go out to Clapham, or if they all still want to stay in London.
Gentrification and basically spreading the wealth.
Yeah, then the school teacher or the black cab driver who bought a house in a suburb of Clapham, say, or Balham, or one of these suburbs of London, Islington, 15 years ago, when it was a perfectly acceptable middle class place to live, they then get £2 million for the house they bought for 200 grand. And they then move down into the depths of Kent or out into, rural Warwickshire or Dorset. And that factor has been really specific and it's an exogenous shock to British property that's not about the fundamental value of property. And I just wonder, we've gone rather down the rabbit hole on property, but I wonder how long, I guess the question is how long duration that can be before it starts unwinding. And actually, I think the answer is, it's probably going to carry on until the population of the world hits 9 billion. And whilst China continues to deliver astonishing progress and GDP growth. So, that's property.
another, and if I may add, I think the fact that the UK has such a mature legal framework to just store wealth is quite important for property. And it's another factor that, some people think of property as a store of wealth. Instead of having money in the bank, I store it in property. And to be honest, I don't want to earn 10% per year. I'm fine with perhaps a lower amount, just knowing that I have this asset which will definitely appreciate as much as inflation will do, and have something that I can then pass on to my kids, and no one can take it from me, right?
That's a very important point. The inflation point is the other one you reminded me. The other thing I want to say just quickly is, it's very important to disaggregate the nominal increase in property prices, in all prices, whatever asset you're looking at, the difference between nominal and real. And in a depreciating currency, there is a big difference. So, and the way I put this, like, say my parents bought a house in Wimbledon or Southwest London in 1973 for £15,000, and it's now £500,000, right? So, what percentage of that is a real return and what percentage of that is a nominal return because the value of the pound has fallen 90% since 1973? Well, property in the UK has made very significant real returns because everything we just said, like a tidal wave of international money and interest rates and everything else. But I I think people have got to remember that if a pint of beer in 1973 was 1/20th of the price it is today, or more pertinently, you've only increased your wealth in terms of number of nice houses in that area. You haven't increased your wealth, because if you sell that £500,000 house today and you want to buy another one on the same street, you can only buy another one. You can't buy two, So like, it's a bit of an ephemera that I think too few people really, and certainly too few estate agents really get, is the difference between real increase in the value of property and just nominal, because the currency's been smashed to smithereens.
Yeah, and inflation adjusted returns. Every time that we talk about returns, then we should definitely consider that inflation diminishes those returns in real purchasing power,
and also get to grips with just how bad government inflation statistics are, without wanting to sound like a conspiracy theorist, but they are.
Tell me a little bit more about that, because I have in my notes that I really wanted to talk more to you about that, because it sounds like a conspiracy theory, right? The government says lies about things, but then how should one interpret the 2.4% of inflation that was just released as we talk in August 2021?
Well, I mean, like all the best conspiracy theories, it's there hiding in plain sight for anyone who can be bothered to Google it and learn about this stuff, right? And then it becomes a philosophical and intellectual argument. But to me, there are three things that both the BLS and the ONS do to inflation calculations on both sides of the Atlantic, which they argue are valid, and other people, I think quite smart, old school people who follow Austrian school economics, argue isn't valid. The reality is probably somewhere in the middle, but at least people should be aware of what they are, right? Which is geometric weighting, substitution, and hedonic adjustment. So substitution is inflation is calculated from a basket of goods every year. The basket changes. Now, of course, should argue.
Who decides about that?
Well, the government, the ONS, the Office of National Statistics, right? Now, of course, the basket should change, because we shouldn't be using, Austin Allegros in the automotive field. Products change, but it's very easy for them to say, we used to have cod fish in the basket, and cod doubled in price because of the Atlantic cod banks being depleted and Spanish fish overfishing, and there's no cod. So okay, let's get rid of that as our exemplar fish and put in farmed salmon, which is cheaper because Norway and Scotland are farming loads of salmon. So that's very easy game to play. Or you replace beef with low quality meat of some kind, and they that the basket changes a lot. And I think if you really look under the hood and say, are these changes valid because the world's changing, or are they actually trying to massage the number down? That's just for people to make their own decision about, but it looks that way to me, and people far smarter than me. The other one is geometric weighting, which is the fact that, so for example, in the States, healthcare inflation, because of an old elderly population, really expensive drugs,
it's gone crazy, right?
Going crazy. Healthcare inflation has been running at between
with education.
12 and 14% per annum for like 20 years. I mean, it's, there are drugs that cost $1.5 million. Now, obviously they're very rare drugs for rare cancers and stuff, but still.
$1.5 million per person.
$1.5 million per treatment per annum. Yeah.
Oh, wow.
What are they called? Anyway, I'll come back to that.
Can biotech companies help here?
Yeah, well, that's what they're trying to do. I mean, so I'll digress quickly. One of the companies I was working with in the last few years in the biotech space brought the cost of a treatment down from $3 million per treatment to $300,000 per treatment. And they're trying to bring it down to $30,000 per treatment. And if they do, that's a Novartis drug called Kymriah, which basically not cures leukemia, but it has amazing response rates for children with leukemia, that sort of Great Ormond Street poster child. Not a lot of people know that. That drug was approved in 2017 and is really, really making a big impact on kids with that disease. And if they can get it from $300,000 down to $30,000, which I think they can, that's my human progress point again. But anyway, going back, so geometric weighting is where the authorities also have the optionality over how they weight different sectors of the economy in the inflation calculation, right? So in America, the inflation in healthcare is enormous, as we've just said. It's double-digit inflation. It's also 17% of US GDP. The healthcare sector, all in, is about 17. I mean, it changed a bit. These numbers are probably a couple of years out of date, but broadly, it's probably more than that now. But anyway, it's certainly around 17% of GDP. It's only 6% of the inflation calculation. So they just kind of go, oh, that's a bit inconvenient. We've got a really elderly population and inflation's running, drug inflation and hospital care inflation and health insurance inflation is all really high. It's 17% of our economy. Well, just to put it in there at 6. Now, that's one that I find quite egregious, and I don't know quite. I forget how they judge. There's an intellectual argument as to why they do that, and what it's probably something to do with the percentage of the population that's affected by that, because it's mainly the elderly or whatever.
I see.
Right?
Okay,
But let me just give you the final one, which is hedonic adjustment. And hedonic adjustment's used to adjust nearly half of the factors in the basket, right? And what that is that if in 2020 there's a 55-inch Samsung TV that's £1,000, and then the following year the new Samsung TV is still £1,000, but it has a slightly better screen and it has like a button, it has a go straight to the Facebook button on the remote control, and it has a better speaker, and but broadly it's the same 55. So there are qualitative improvements in that product. The inflation calculation they will subjectively say that we think this TV is 20% better than the TV last year. It's still £1,000, but in the inflation calculation, it's 20% less than it was the year before, because they say the product's 20% better, so you're getting 20% more for your money, right?
Okay, so in terms of...
So go on.
So if I hear you correctly, the inflation is not it's definitely calculated in different ways, okay, depending on the government, of course, and depending on the factors that they will put in, and lots of things affect the inflation. So what would let's say a real inflation number be? It's not 2%, right? It must be higher than
that. So the argument is it's extremely hard. I mean, ultimately money and the economy is a sort of philosophical construct anyway, and we're all going to argue about what's real and what isn't real. And but I think there's actually a website called shadowstats.com. And it's pretty controversial, but if you want to see the sort of red in tooth and claw, disgruntled former, the guy there, I think he basically used to be very senior in the US regime in some shape or form, the comptroller general, or he worked in Washington DC on a lot of economic analysis and data crunching for one or other of it wasn't the Fed, I don't think, but it was one of them, and he's got this sort of pretty aggressive website that basically says that it does things like say, if you use Clinton changed the definition of how US inflation was calculated in 1996 after a review by a thing called the Boskin Commission. And basically, if you use the pre-Boskin numbers, inflation's actually something like 7 or 8% per annum instead of 2. So, and of course, it's important to be clear, I'm not saying I totally credit shadowstats.com, but I certainly don't think inflation's 2%. If inflation's 2%, how come every stock market in the world's at all-time highs, every property market's at all-time highs? I mean, I know that's asset inflation, but to me, it's just a nonsense that we, with a straight face, can look at all these things that are up 9% per annum for the last 30 years and say, oh, inflation's 2%. It's just mad. And I know that the countervailing factor is, consumer electronics, although iPhones are looking a bit expensive at the moment. Mm-hmm. But I think, the other thing is to say on this subject is, why would governments consistently try and represent real inflation to be lower than it really is for most people's experience? And that's because it's the basis. It's used as an input to the calculation on all of its social security payments, right? And it also, if you own up to the population that the real inflation rate is actually 5% and interest rates are 0.5%, everyone in the world, everyone in your population is going backwards financially to the tune of 4.5% per annum every year.
There's going to be riots.
Yeah, well, great. And John Maynard Keynes, the great 20th century economist, said that not one man in a million can diagnose inflation. And I think that's probably a little bit, maybe in 1945 that was true. Maybe now it's not 10 in a million, but I think a vast majority of people are just, even, analysts at investment banks, because they've never really looked under the hood, and, senior traders or whatever don't really think about this stuff or get to do the boring academic work. Yep. So I think it's pretty poorly understood. But the last thing I'll say about inflation, though, is inflation is a very personal thing. It depends what you buy. I know that sounds really...
Exactly. It's a personal inflation thing, right?
Right. So what the government says, but to my mind, what do we buy? What are the biggest things in our life we buy? Property. Right. What's your biggest monthly outgoing? It's property.
Car, groceries.
And whole fire, what's property been doing for the last 20 years? We just said a minute ago.
Yeah,
that's pretty consequential. You're not enjoying low inflation when it comes to your rent or your mortgage payment, right? Next one, car. Well, again, if you looked at the price of cars recently, I mean, I remember when a Golf was like $8,000, and now it's like 38,000.
Yeah,
right?
second hand cars have also gone up in value.
Yeah, and that's a particular coronavirus supply issue. You know, there was that chip manufacturing problem, and so they can't
shortage.
Yeah, exactly.
Yeah.
And you know, the whole supply chain's been battered by Brexit and coronavirus and da da da. So there's no supply in the supply chain, and so you can't buy a new car. So everybody who wants that car is going to the secondhand market. And that's right. And then what's the net? You know, food is probably one that's been all right because there's been this huge agricultural. Although I mean, things like cotton and coffee and wheat, and you know, there's a massive commodity bubble going on right now, which is a monetary thing and a post-coronavirus thing and a supply chain thing. But I just, to me, if I look at my own insurance up massive, air travel up massive, you know, all the main things that I need to spend, healthcare, we just said, up massive, and more as we have an age of inflation. So when the government tells me inflation's 2%, I just absolutely think that's just complete nonsense. And I think anybody else who really stops and thinks about their own personal experience of the price of the stuff, the big stuff they need to, you know, if you weight it according to what you're spending on it each month, inflation's not 2%. So anyway,
that's a good business idea. Put in what you're spending, and then I will calculate the personal inflation for you. Here's, you know, if anyone has this business, wants to pursue a business idea, here's one.
Yeah, that is a good idea. Although one thing I've learned over the years is most people are incredibly turned off and bored. This is certainly. I'm going to a wedding on Saturday. My wife's mate's getting married, and I won't be talking about inflation over the drinks. I shall. Well, I'll never be invited back to another one.
I guess the side question to inflation is, okay, I know there's inflation. I know that things are getting more expensive. What can I do about it? Like, what can I do?
Own equities.
Own equities. Okay.
And this is why, like, one of the things that makes me laugh most in the last few years is all these talking heads screaming about crash, 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 crash. You know, because of government debt and inflation and like. It's completely 180 degrees the wrong way around. Why is the S&P gone from 666 to 4,200? I keep saying 4,200. I don't know where it is. Whether it's
probably 4,400 by now. I'm transferring my pension, and which has a decent amount in it, and I'm really I don't really want to keep seeing it going up in value because I'm in cash right now, and I'm losing whenever it goes up every day until the transfer is complete.